we've been doing a number of the presentations. It's kind of nice to be actually do something other than PPP loans. Been doing a number of those. So now we're going to talk about year-end planning. This year, as things are a little different, much is the same. What we're going to talk about today, we're going to talk a little bit about the planning process, a little bit about what to expect from elections and what may or may not change. I'll concentrate on some business deductions and some things that apply to individuals and a little bit on gifting. And then hopefully wrap up in time to answer a few questions and so we can get done within an hour so you can get on with your day. With that in mind, let's get started. I think one of the big takeaways is remember that tax planning is a process. It is not an event. Tax planning is you do taxes this year and in future years. So we want to make sure that the combined total is the correct result, not just any one individual year. And that's one of the biggest problems we see with people is they just look at how to minimize taxes. This means that you may pay a little more tax in year one to reduce taxes by more than you increase in year two. And it also is made more difficult by you have to predict the future. And when you predict the future, there's a few truths you have to keep in mind. If you predict your income, the actual result will be higher or it will be lower, but it will never be the predicted amount. And tax laws are always permanent until they change. And boy, have they been changing. Not only retroactively, not only prospectively, but also retroactively. But it also is very important that actions without consideration of the future will rarely, if ever, lead you to the best result. Serendipity may occur and it may be right, but it's better to think about what may or may not happen. Use your insight, the knowledge of others, and try and come to the best overall predicted result. So what do we think might happen in the future? So the election is results are pretty well in, and we'll have a new president in January. One of the things President-elect Biden did is he actually had a lot of notes on really what his thoughts were on future taxation. So these are not all the things that he was considering. These are just some of the things that he was considering. So if you look for individuals, he was expecting to increase the top tax rate back to 39.6 from 37%. One of the more unique things is he would extend Social Security taxes to earnings above $400,000. So just as a refresher, remember that Social Security taxes, the 6.2% Social Security tax, half with a matching 6.2% paid by the employer, is taxed on about $140,000 of wages. Now, the way it's done now, once you've hit the maximum amount, then the rest are, there is no Social Security taxes withheld on that. Medicare, yes, but not Social Security. Well, the proposal would be that once you get up to 400,000, Social Security taxes would kick back in. So kind of like a version of a donut hole type issue. Another unique thing is long-term capital gains would be taxed as ordinary income if you had over $1 million. And but there'd be a removing the cap on taxes deducted for itemized deductions is something new. Bringing back, what's old is new. That would come back. But a unique aspect is when you're looking at itemized deductions, you would look at, rather than paying tax on a rate schedule based upon the ordinary income, but based upon the tax after itemized deductions as one rate schedule. If your rate was a, pardon me, if your income tax rate was above 28%, they would only let you reduce your taxes by 28% of the itemized deductions, not more, not a greater amount if your ordinary income tax rate is greater than 28%. Kind of a unique thought. The next one is the child tax credit would increase to $3,000 for dependents under 18, with an additional $600 credit if the dependent was under the age of 6. So it's kind of a unique credit too, where you'd have a sliding scale. And reinstate the first-time home buyers credit for those of you with a, I remember in the Great Recession when there was some credits for home buyers. They're looking that that might come back too. Business taxes, they just reduced the corporate tax rate 2 years ago from basically a 34-35% rate down to 21. They're already talking about increasing it up to 28. And there'd be a corporate minimum tax on book income, but it's only book income over $100 million. So for those of you that have C corporations, if your income's not over 100 million, you don't have to worry about this new corporate tax. And I have this QBI, or qualified business income. I'm listing it as a business tax, even though it applies to individuals. It would remove that 20% deduction on if your taxable income is above 400,000. What the QBI is meant is to get individual tax rates closer to what a corporate tax rate would be. So what this would do is it would not allow you to get closer to the corporate tax rate if your income is above $400,000. So it might change quite a bit if that happened. It meaning your personal tax structure may change a lot of things. The estate and gift taxes, they would eliminate the step up on basis on death. We'd go back to the 2009 exclusion, which is about $3.5 million. And rather than having estate and gift taxes as one uniform system, they'd have a separate gift tax system where you'd have gift taxes begin at gifts over $1 million. So a lot of different things are in there. I have to give him credit for putting so much out ahead of time. We appreciate that. It gives us some insight, but like anything, even if you are president, you cannot make things happen just because you are you. You need people to help you get things done. So when you're looking at how things can get done, we need the president and the House and the Senate need things to work. Well, we know that the Democrats control the House, and we know that they can push anything through that they so wish. And that's fine because they have the enough votes that they can do that. The Senate is a different body. So currently there's 2 Senate seats that have not yet been determined. Both those Senate seats are in Georgia. There'll be a runoff election happening in January. For those of you that wish to participate in that vote, as long as you move down to Georgia and change your residence by the 4th of December, you can participate in that vote. But even if both of those seats move to the Democratic side, if they win both seats, if we do that, we'd really have a 50-50 split out of the 100 seats. Yes, I know it's technically 49-49-2, but of the two independents, one always votes with the Democrats and one always votes with the Republicans. So let's just call it 50-50. Vice president gets to break ties, so it looks like the Democrats could control everything, 51-50, right? But can they? And there's a couple things we have to keep in mind. One is there's some old rules in the Senate, and it's the way that their body runs, that any senator can institute filibuster. And filibuster is not what we learned about when we were in school, where somebody has to stand up and talk about a bill. No, they've made it too easy. All they have to do is say, I am going to filibuster. And then the bill just sits there till someone removes it. It meaning the filibuster. To remove a filibuster, you need 60 votes. That's tough to do. So it makes it tough to move bills through. The Democrats could remove the filibuster rule if they want to, right? With using that 51-50 system. But there's one Democrat from West Virginia that says he's not going to vote to eliminate the filibuster. Well, that means that the Democrats can't get to stopping filibuster, because then it'd be they'd only have 49 votes. Secondly, the other issue is the issue with the party itself. The party is quite diverse. It's not quite as united as the Republicans. Not saying right or wrong. I'm just saying how they are looking. And so it'd be tough to get bills put together, especially on taxation, that everybody could get behind. So even though that they technically could control everything, it'd be difficult to get things as controversial as taxes through in their system today. But what this is, it's just an opinion. It's my opinion based upon what I've heard over the past 6 weeks and from a multitude of sources. But it's politics. You never know what's really going to happen. So what should you do based upon the elections? Well, one thing that I can say with certainty that I would advocate is, if you're impacted by the $10,000 cap on taxes, remember that includes property taxes, personal property taxes, as well as income taxes. Pay your state estimated taxes for the fourth quarter in January. Do not pay in December. Why? Pardon me. It's because there is no upside to paying in December. But if things do change, and if in 2021 they would allow you to deduct more state taxes paid in 21, if you pay it early, you can't add it to that bucket. If you pay in January, you have the potential. So there's potential upside, no downside. That's what makes sense. If you believe tax rates are going to increase, you might want to consider Roth conversions, paying tax today and at a lower rate than what you believe the tax rates are going to be down the road. If you think that first-time homebuyer credit is going to go through and that will push up the value of first-time houses, you could consider buying some homes on speculation to sell after the credit comes in. If you believe that the itemized deductions are going to be capped in the future, you could look to set up a donor advised fund. In other words, accelerate charitable donations. This one is something that we're talking to more people about doing. Because again, if your tax rate is going to be the same this year as next year, the value of your itemized deductions will be the same this year as next year. If you take those itemized deductions, those charitable contributions this year, you know there won't be a problem with them getting capped. If you take them next year, there's a potential for those deductions to be capped. So you might want to consider doing a donor advised fund this year to mitigate that risk. Again, and this is one of those I look at, there's not really a downside and the potentially could be an upside. And if you believe the estate taxes will be increased, you might want to accelerate some of your gifting now. Those things make some sense. So in other words, it's about putting what you believe is really going to happen based upon what I'm telling you from the reading of the tea leaves for what may or may not be happening in the Senate. We don't expect a lot to happen in the next couple of years. Why in the next couple of years? Because remember, in 2 years, there's a bunch more votes. There's a bunch more people running in the Senate, and maybe some things could flip. But for now, I'm not worried about substantive changes in the next 2 years. Well, here, as far as business deductions, one of the big things we're talking to people about is qualified improvement property, or QIP. So first thing, before we talk about it, have to know, what is it? So qualified improvement property is any improvement made by the taxpayer to the interior portion of a non-residential building after it is placed in service. So after you buy a building, if you fix it up, stereotypically you buy an office building, what happens is you build to suit the interior to build for the tenant. That's the kind of things they're talking about. It excludes what we call the 3 E's: elevators, escalators, and expansions. But it does include roofs, heating, venting, and air conditioning, fire protection, and security equipment. Now, why is this important as a fact? It's because the CARES Act corrected a drafting error. So in the Trump tax bill, the TCJA, is a lot of acronyms I know, but just stay with the Trump tax bill. There was a drafting error. Qualified improvement property was meant to qualify for bonus depreciation or first year upfront depreciation. It's very clear that that was what was meant in the debates and in the legislative history, as there was just a mistake in the bill. Well, the CARES Act fixed that drafting error. That means qualified improvement property does qualify for bonus depreciation retroactive to September 28th, 2017. Because that's when that's when all those changes went into effect. You have a choice to take this extra depreciation. You can do it on prior returns and amend those prior returns. Or you can make an accounting method change and catch up the depreciation in 1 year. It's a choice. Now, I will tell you, for most of our clients, the choice we're going to be making is to make the automatic accounting method change, most likely in 2020. A big reason for this is because when you amend returns, since most businesses are a flow-through entity, meaning the entity calculates its income and passes that income out to the individuals pay the tax. I have to amend a business return and I have to amend the owner's returns. If I do an accounting method change, I file a form with the tax return and do some calculations. There is some work with it, but I add these deductions to a return I'm already filing. And when I do that, it's much more cost effective, much easier, much to do. So some of these adjustments can be fairly large. If you think about if you buy a office building and you make it custom, the interior custom for a tenant. So you had a certificate of occupancy and you then redid everything for that tenant. We could be talking many hundreds of thousands of dollars potentially. So you really want to be thoughtful in what you want to do and decide what's going back. And these accelerated tax deductions can lead to net operating loss carrybacks. This is another change in the CARES Act. So the TCJA, the Trump tax bill, eliminated NOL carrybacks starting in 2018. The CARES Act, which was passed in March of 2020, reinstated NOL carrybacks for 2018, 19, and 20. That carryback period is 5 years. The old rules used to be 2 years. You can choose to carry back, or you could choose to carry forward each of those 3 years, 18, 19, and 20. Make independent decisions on those 3 years, but that decision is made in your 2020 return. What is best for you? Like all good tax answers, it depends. So, because you have to look at this. Remember, the carryback period is 5 years. From if I have a large loss in 2020, and I go back for 5 years, I'm going back to 2015. The tax rates in 2015 are the old tax brackets, which had a potential 39.6% benefit. Where if I carried that loss forward under today's system, I could have a maximum 37% benefit. So it's a matter of looking to see where your incomes are and what the dollars impacted are to determine what you really want to do. That's why it depends. It depends upon you and how things are going forward. And I can't do a 2020 seminar without talking about PPP loans somewhere. So PPP loan forgiveness has an impact in 2020. The PPP loans were part of CARES Act. They're loans to small businesses to help them take care of some expenses during these times when everything was upside down. In that statute, it said that this loan, if it was used for qualifying expenses in the right ratios, the loan received would be forgiven, and that forgiveness is not taxable income. Absolutely crystal clear. However, they did not address how to handle the expenses. It was a drafting error. The reason it was a drafting error is you could see from the congressional intent that they expected people to deduct the expenses that they paid with the PPP loans. However, they didn't put it in the bill. So recently, the IRS has said back in May that those expenses paid with PPP loan proceeds that were forgiven are not deductible due to a code section that's already in place. And the IRS also recently, in the last couple of weeks, made it very clear that their position is it's not deductible, because they put out a revenue ruling stating that they're not, and even if the forgiveness is applied for in 2021, that the expenses are not deductible in 2020. Well, how is this going to affect my qualified business income disclosures? how will Congress, will they go back and correct their drafting error and allow expenses paid with PPP funds as an income tax deduction? There's legislation out there to do it, but again, we have to get people to agree to get something done. As you know, it's been difficult to get parties to agree on things. But there is hope. There is hope because there is a required bill that must be passed. The government runs out of funds on December 11th. After December 11th, there's no more funding for the government. So they have, Congress and the president have to agree on a continuing resolution, hopefully before the 11th versus after, and to keep the government moving forward. As we know, with many tax bills, with many bills, period, that have to be passed, Congress will usually add other stuff to them to get it through. Maybe some of this PPP stuff will be attached to the continuing resolution. Stay tuned. But because I'm saying stay tuned, we're already talking to people about whether or not they should extend their 2020 returns. Why? Well, it'll allow Congress more time to act on the deductibility of PPP expenditures. It's much better to be able to file a return once, knowing what the rules are. It'll allow the IRS more time to give us information for these QBI disclosures. It'll allow more time to see how the president and Congress act together, to see if there might be things moving very fast through Congress and the president. It could happen, you know, the famous first 100 days for every every president's new term. We want to, maybe things will happen. Well, if we extend the return, we can see what's going to go on. And again, it's far more efficient, that is less costly, to extend than amend. And to make it even more certain, there are certain partnerships that cannot be amended to pass those deductions through to the partners due to some recent tax changes that we'll get into it. Just if you want to know more details, we'll be glad to share, but there are certain partnerships where that's an issue. So think about it. It's better. Hindsight is can really help. Now we're looking at individuals. So for individual income taxes, the CARES Act suspended required minimum distributions, RMDs, for 2020. That is for any amounts that had to be paid out, even for inherited IRAs. So we should all defer income and not take out RMDs if we don't have to, right? Remember the theme of the day, it depends. What is your current tax rate? What do you think your future tax rate is going to be? And here, what is the future tax rate of your potential heirs? Because if your heirs inherit your IRA, they will pay tax on the distributions, even if there isn't, even under the current system, there is no step up on basis on IRAs. You have to consider those things. But another big issue is, for many people, if all you have is maybe a little bit of interest and dividends, Social Security, and your required minimum distribution, if you don't take out your RMD, your income might be below your standard deduction. Those you could have taken money out at in essence a zero tax bracket, or You might also not be using the 10 and 12% brackets, the lower brackets. Why wouldn't we use those brackets? Because it's very unlikely your heirs would have a bracket that'd be less than 10 or 12%. Just things to think about. So sometimes putting off the tax is not the right thing. Or maybe you don't take out the RMD, and what you do is you do a Roth conversion to use the low brackets. That's where you don't take the money out. You elect to pay tax on a portion of your IRA. The amount's up to you. You just say, by this conversion, you say how many dollars it is. And then currently, Roth IRA accounts do not have any required minimum distributions. So now it reduces your RMDs for your regular IRAs prospectively, and it allows the future earnings to grow tax-free rather than tax-deferred. And you're not taking the money out, so that growth is not, you're not paying tax on an annual basis otherwise. So it's really that's something else we're considering. This slide here is not really a planning per se. It's more to make sure you know, to clarify some confusion I'm hearing on some of these payments. So economic impact payments, EIP payments, or stimulus checks. These are the $1,200 checks that many of you may have received during the year. These are not taxable income. It is not taxable for federal. It is not taxable for state. So it's not taxed, period. The unemployment payments, meaning if many people were laid off and they're getting state unemployment, and then in addition, for a period of time, there's this federal unemployment payment of $600 a week. Those payments are taxable income. Both the state amount and the federal amount are taxable income. Don't get them confused, and please don't be surprised down the road. There are a couple other individual issues that we might actually have amended returns for, because in the CARES Act, they went backwards again and did a couple things on excess business losses. So that is if you had some flow through losses that were very large, you may have had some of your losses limited. Those limits were removed for 18, 19, and 20. Also, the interest you can deduct on certain flow through businesses was loosened from a 50% limit from 30%. So there might be additional deductions available. Those are some more complex things, but we are talking to certain people about it. And I just want to make sure you were aware of it. And when you're talking taxes, remember, there's also state issues. And the state issues, if you think the federal legislature can't get anything done, Minnesota has shown even more resistance to getting many things done. There was not a tax, even though we had the Secure Act, which was the most significant changes to the IRA rules in more than a decade. And then we had there's a number, but two very significant tax acts, the Family First Corona Response Act. That was the one that gave the credits for retaining people on payroll. And then the CARES Act, which addressed many, many things. None of those acts have been incorporated into the Minnesota tax law. This is going to create some additional complexity when preparing your income tax returns, because for Minnesota to adopt any of the federal changes, none of it moves automatically. They are required to act, to choose to adopt those changes. So that means we have two separate systems right now. It's a nightmare. The legislature did manage to address two things, and it was just recently here, I believe, that is had to do with property exchanges, and also Section 179. So one of the big things, positives for business owners, is that beginning in 2020, the federal Section 179 depreciation is allowed to the extent for federal, plus you'll have the carryover deductions from previous 179 expenses not allowed. So your Minnesota taxable income may be lower than your federal. For charitable planning, that's right, look for your favorite new deduction here. If you take a standard deduction, you can deduct up to $300 of contributions to charity, even if you do not itemize. It has to be cash, and it has to be amounts given directly to the charity. There's a lot of rules for that $300 deduction. It's $300 on a return. So if you file as a single person, you're allowed $300. If you filed as a married couple, you are allowed $300. They also, though, allowed you to take more cash contributions to offset up to 100% of your adjusted gross income, rather than the normal 50 or 60% limits. Gifts of appreciated securities, these rules did not increase. And normal for most of you, a gift of appreciated securities, you have a limit of 30% of adjusted gross income. So what should you do? Think about donating highly appreciated securities held for over a year. I know the rules didn't change, but the market's changed over the last couple of years, where the market's gone up substantially. You could use those to create a larger deduction this year. And I'll use that larger deduction to help reduce your income. You could also use this larger deduction maybe to use as an opportunity to do another Roth conversion. In other words, I have extra deductions. I may want to offset some of my another taxable income. Just things to think about as you go through. Estimated income taxes. We had many people with the uncertainty of what was happening in the first part of the year, and two, with the lack of cash flow in the first part of the year. They may have shortened or paid lower amounts of estimated tax payments in the first part of the year. If you find yourself in that situation, what should you do? Well, you have some choices. You could catch up now, and just write a larger check now. That will help reduce future interest charges. Current interest rate is 3% federal, 5% state. Those they call them underpayment charges, but they're just think of it as interest. That's all it really is. You can increase your withholding. So if you're getting a paycheck, you can change your W-4, your withholding statement, and ask for extra to be withheld. If you do that, withholding is deemed paid throughout the year. So even if you're having it paid in December, you get credit as if you paid it throughout the year, thereby reducing those 3% and 5% interest charges. Now, if you're retired and you didn't pay your estimates as you went along, because for the same reasons, how do you get more withholding? Well, one way to do it is to take money out of your IRA, have withholding taken out, federal and state, and then you roll the excess back, plus you take the net check, and then you take after-tax funds you got in your checking account, and you add that to it, and you put the money back in your IRA within 60 days. That is a qualified rollover. So you will not pay tax, but you actually have withholding. So that gets you withholding that is deemed paid throughout the year, thereby reducing your interest charges. But watch restrictions, because you can only have one rollover a year, and based upon different accounts. There's some technical things, but a short answer is if you haven't done any rollovers, you didn't put money back into your accounts during 2020, this would be an opportunity to do that, help reduce those interest charges. Another option is you just pay in April and you pay the interest to them, and you say, Todd, it's not that big a deal. And that's okay. As long as you're making that decision for you, it's your decision what you want to do. But I always remember way back in time when taxes were actually due in April. You know, this is the year we call it the year of the never ending tax season. Seems like I was filing system all year round. Well, you've been very patient. We're getting towards the end here. So just a couple slides on gift planning. And the first issue is nothing new. It is, but it's just reminding you that there is an annual exclusion. You can get that if you give an unrestricted gift to people, you can give up to $15,000 per year. And that will help you reduce your estate, and there's no gift tax, there's no reduction in value. I mean, there's no reduction in the amount of your lifetime credit to do that. Your spouse can also give $15,000. But this is a use it or lose it. You can't say, well, I didn't do it in 19, so in 20 I'll add 19 and 20 together. No, it's each year stands on their own. So and you can give it to whomever you want. Everybody on this phone call could receive $15,000 from everybody else in this meeting. That's not a problem. One of the other things we're talking to people about is low interest family loans. The government has minimum interest rates that are required. These the actual rates are calculated each month based upon loans taken out in that month. They're based on loans of 3, 9, and greater than 9 years. So you could have a family member have a 30-year loan from you at 1.31%. If you wrote that loan in December, 1.31%. That's almost zero, probably greater than you're getting at your bank currently. You could also do a 3-year loan as low as 0.15% annual. 0.15. That's almost nothing, right? So use that that's a way to help out family members today. And it may be nice to do something and rather than have them wait till you're no longer around to be able to do anything for them. Something to think about. If you have a larger estate though, there are other techniques to use in transfers. What we're doing with these other issues is we're taking advantage of the current low interest environment and using these current low rates as a means to be able to transfer dollars in a more efficient manner. So that would be, you can have an installment sales to a grantor trust. Those doesn't create an income tax in that situation, but allows you to transfer assets, and the interest rate's very low. There's what's called a grantor retained annuity trust, where you look at calculations of expected growth, which are based on those interest rates that I showed you. compared to what in an income stream you have to receive in exchange for assets transferred. Another one we're looking at is called a charitable lead annuity trust. Many of you may have heard of charitable remainder trusts. That's where you give money to a charity in exchange for a payment stream. What about if you did the other way around, where you put money in a trust and the charity got a payment stream, and then at the end of the day or the end of the term, the residuary went to your heirs? Today's low interest rate environment, there may be a way for you to get a charitable donation and a very efficient transfer of some appreciating assets to your heirs. So I don't want to go through the details here. It's beyond the scope of this presentation to do in a couple minutes, but I do want to let you know that there's other options that might be useful for you. Pardon me. Well, I made it through what I wanted to talk about. And what I'm looking at now, just to see some of the questions here. The question has to do with following through. I have a question of what deductions from AGI are available when taking a standard deduction in Fed in Minnesota. So for Fed purposes, it is mostly your retirement account. The ones you see most often are, IRAs, pension profit sharing, half the Social Security paid on earnings. The new one for this year is the $300. The $300 in addition to for non-itemizing people for charitable contributions. That's really the only new one. There's another minor one that has to do with trusts that are terminated in 2020. There's a potential to get a deduction as a deduction from AGI. That's not an itemized deduction. You will know if you have this based upon the disclosures in a K1 you get from the final year of a trust. Very esoteric, but it is new this year. Minnesota, one of the things to keep in mind is for Minnesota, even if you itemize, if you don't itemize, if you don't itemize, Minnesota has had a provision for many years that donations made in excess of $500, you can deduct half the donations made in excess of $500. So example would be if I donated $2,000 and I take a standard deduction. Minnesota would say, okay, take the $2,000, subtract 500, gets me to 1,500. I can deduct half of the $1,500 or $750 on my Minnesota return. That is something new this year. It's not new, but it's something that's been there for a number of years, and that's something new that we have to consider for Minnesota. Biden has proposed eliminating step up in basis, and someone's wondering if it could be retroactive. All the proposals I've heard have been a prospective change. It'd be really tough to go backwards. And I have not heard of anyone requesting it go backwards. So it'd be on deaths after a certain date. So I wouldn't worry about things I've already inherited. Question, if you've already elected no bonus depreciation, can you go back and amend for bonus QIP or make the accounting change? If you elected no bonus depreciation for that year, that is going to be a problem, because then I can't really amend for that bonus QIP, because I'm not going to take a bonus. I'm not eligible for bonus in that situation. So I don't believe we can do that. And then the question is, if you overpay tax, can you get 3 or 5% interest on the overpayment? Well, there is, what you can do, there's a few things we can look at, some gamesmanship. So what happens if you don't take all the deductions you're entitled to, or you pay tax on income you don't have to? So one of the things I played with mentally was, for federal purposes, you could take out, I believe it's up to $100,000 from your IRA for coronavirus related expenditures. Some rules, but there's an ability to take the money out of your IRA, and you can pay it back into your IRA over time. So what if you took the money out in 2020 and you paid it back in 2021? Well, then what you're supposed to do is go back and amend 2020. Well, if you wait a period of time to do that, the government would then owe you interest on that. For federal purposes, it's currently 3%. But then you got the administrative cost and hassle of doing all that. But yes, it could be done. So it's that's what it is. If you just don't take all the deductions you're entitled to, or you include income you didn't have to. If you took partial required minimum distribution, can you do a Roth conversion from an IRA? And that I can say is yes. Yes, you can. And you can choose how much. But to do a Roth conversion, the conversion must be done within 2020. You cannot look to see where your income is, say, okay, now I want to do a conversion. Say in April, you realize you're in the low tax bracket. Oh, I want to do a Roth conversion. You can't. No, you had to have done it. And unlike the rules as it used to be, you can't undo it. If you did it and something comes through that you didn't expect, you can't undo the Roth conversion now. Can you give more than $15,000 to a person, file a form documenting? Absolutely, yes, you can. You can. That $15,000 is the cap on the amount to give without filing paperwork. Is it wise to pay charitable donations from an IRA to reduce the balance so RMDs are reduced to? Absolutely. If you are old enough, paying your charitable donations from your IRA is always wise. There's a number of reasons why it really works well. One question we've been getting is in the Secure Act, that's the one that delayed required minimum distributions until you are 72. This ability to pay charitable donations from your IRA is still 70.5. Why? Because the 70.5 was hard coded into the charitable donation part. It did not refer back to the required minimum distribution age, so that they left it at 70.5. The question is, the personal standard deduction going to change when we file our 2020 taxes in 2021? They're always inflation adjusted a little bit. I'll be honest, I don't remember the exact amount. I could look it up, but it's already set. It's not going to change. When you see the forms, the number it says is the number it is. So no, granted, could they change it? Yes. Do I think they're going to? No. Because remember what we said earlier, tax laws are permanent until they change. So they can change anything. And they're showing us that they have changed a lot of things. So we've got that a lot of those things going on. I appreciate your attentiveness. I appreciate you making the time out of your day, because this is a personal choice of your time. We may not charge for attending this, but your time is very valuable, and we appreciate it that you spent some of your time with us. And as I see, we've got the questions answered. I'm within a couple minutes of the time, and like any good educator, letting people out a couple minutes early is a good thing. So you have a wonderful day, and we'll talk to you later. Have a great day.